There's a lot going on in the markets right now, and one of the biggest is the audacious move by Tesla's Elon Musk to buy Twitter outright for $44 billion. The story has captured the interest of the world, with certain sections of the media outraged as Elon plans to inject some controversy back into the online echo chamber, with one of his first acts hinted as being to reinstate Donald Trump.
There are big implications for the investing world too. How is Elon financing the purchase? And what is the impact for Tesla stock, which is tied into the deal? With such a big shake-up at the top of the S&P 500, what impact might we see in our index funds and ETFs?
Elsewhere, the emerging markets have been in a downward spiral since the start of 2021, seemingly without any light at the end of the tunnel. It's now at pre-pandemic levels, reversing all the gains made since. As we've always been cheerleaders for overweighting the emerging markets in our portfolios, are we now eating humble pie?
As we said, there's a lot happening at the moment, so in this Investors Roundup, we're also going to be covering the shocking collapse of Netflix. What's the impact for your portfolio? The average UK property has climbed £20,000 in just 2 months, but is property now dead as an investment? The UK Treasury is to launch its own Royal Mint NFT in a major first move into the crypto space. And finally, the yield curve has almost gone flat, the surest sign yet of an impending recession. Let's check it out. And by the way, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake are the go-to investing app to buy and sell US stocks. There are thousands of stocks to choose from, and they charge 0 FX fees when you trade.
You only incur FX fees when you deposit or withdraw funds, rather than every time you trade, as you do on many other apps. Stake are giving away a free US stock worth up to $150 to everyone who signs up and funds within 24 hours via our offer link, linked to in the video description below. Elon buys Twitter. The world's richest person, Elon Musk, has just secured a deal agreeing to buy Twitter for $54.20 a share, valuing the firm at roughly $44 billion. This is possibly welcome news for Twitter investors, as Twitter stock had been lagging at around the $37 mark since the start of 2022. While most of the news coverage about the takeover of Twitter has been about the culture war bubbling away underneath, we'll leave the whole left-wing versus right-wing story for others to tell. We're interested in the investing implications and which direction this bomb that Elon has planted at the top of the S&P 500 might explode.
The real story here may not be Twitter stock, but Tesla stock. At the end of March, before this story had taken off, Tesla made up 1.33% of the entire world's market capitalization per the weightings in Vanguard's FTSE All-World ETF. Tesla has taken a slide in recent days for reasons we'll soon go into, but it was the 4th biggest stock in the world by valuation and is present in all global and US index funds and ETFs, as well as probably a large number of managed funds and pension plans. The fate of almost any portfolio is in some small way tied to the share price of Tesla.
To secure the deal to buy Twitter, a $46.5 billion financing package was reached by a combination of $13 billion in bank financing secured against Twitter assets, $12.5 billion of margin loans raised from 12 different banks against $62.5 billion worth of his Tesla shares, and $21 billion of equity that he will raise personally.
Prior to pursuing Twitter, Elon had already pledged more than half of his 21% Tesla stake as collateral for other loans. Elon's Tesla equity has been leveraged to the hilt. It doesn't help Elon that Tesla's share price collapsed by 12% in the aftermath of the sale, wiping $29 billion from Elon's personal fortune in less than a day.
If Tesla's share price were to fall by a further 34% to $570, which it was last valued at only in May 2021, Musk would receive a margin call and his Tesla collateral could be taken by the banks. That could force Elon to sell some Tesla stock, causing further downward pressure, forcing other big players to sell who also get a margin call. It could even be the trigger that fires off a whole market crash.
Tesla investors have also been spooked by the likely source of his $21 billion of equity. According to wealth management firm Wedbush, worries about Musk selling Tesla stock to pay for the Twitter deal and distraction fears for Elon are causing a bear festival on the name. The most recent news is that Elon has indeed just sold $8.5 billion of his Tesla shares, but says no further sales are planned. We'll see.
The collapse of the emerging markets. The decision to invest in emerging markets has always been a trade-off between greater risk and the prospect of higher returns than those on offer from developed nations. However, the war in Ukraine and a worsening outlook for the Chinese economy may be changing the equation. As returns fall and risk increases, is it time to reduce your holdings in the emerging markets?
This chart shows the returns of the MSCI World Index, the poorly named index representing only the developed market countries, versus the return of the MSCI Emerging Markets Index. It tells a tale of how different areas of the world are dealing with the economic fallout from the global lockdowns, with its resulting inflation and higher interest rates.
The main player in the emerging markets is China, making up 30% of the index, whose companies are taking a hammering off the back of the Chinese government's zero-COVID strategy, widely thought in the West to be an impossible goal. While other countries have learnt to live with COVID, China have been locking Shanghai citizens up in tower blocks for weeks without proper access to food and medical supplies, in a perhaps doomed effort to eradicate the virus completely. Actions like this have been taking a toll on China's economy.
Elsewhere, as interest rates rise, developed nations have generally been better prepared to deal with rising debt costs, while smaller emerging market countries whose economies are more likely to rely on a handful of specific resources are struggling to manage their debts. Turkey, for instance, is said to be heavily reliant on oil and wheat imports, while Poland has just had 53% of its gas supply switched off by Russia.
Despite all this, we think you've still got to be exposed to the emerging markets. Ray Dalio argues convincingly that economies move in long-term cycles, with empires waxing and waning. In 1900, British stocks made up 25% of the world's market cap, with America just 15%. The 20th century was about American ascendancy, with US stocks now making up around 59% of the world's value, while Britain entered a decline and is just now worth around 4% of the world. In the decades to come, it may well be China's turn to shine and America's turn to fall back. With prices down, maybe we should be thinking of the emerging markets as being on a fire sale and buying up as much as we can. What do you guys think?
The Netflix Implosion. Netflix has lost subscribers for the first time in a decade, shedding 200,000 users, and warned that it will shed 2 million more over the next quarter. While a significant fall, for context, Netflix has over 200 million subscribers. This bad news has caused its share price to implode by around 50% at time of filming since the news first broke, and is down around 72% since its highs in October 2021. The world's largest streaming service attributed the setback to high levels of competition and more than 100 million households using its platform without paying.
Netflix is right about the increased levels of competition. In the UK, we now have Disney+, Amazon Prime, Now TV, BBC iPlayer, Apple TV and others, while in the US there is also HBO Max, Hulu and Peacock to name but a few. As for the millions of households using family and friends' passwords to access the service for free, this is hardly a new phenomenon and was at one time actively encouraged by Netflix to grow its brand.
As well as fierce competition, we think the other big issue here is the lockdown effect, combined with the cost of living crisis. During lockdown, Netflix's subscriber base and share price went through the roof, with the assumption that this would continue in the years after the great reopening. But now that people have better things to do than watch TV all day, surprise surprise, many people are choosing to unsubscribe. And with household budgets being tightened across the world, many no longer want to pay Netflix's rising subscription fee. As the S&P 500's recent decline shows, Netflix is not alone amongst growth stocks in having its valuation reassessed in the cold light of day post-COVID. Perhaps the US stock market bubble has started to pop at last.
Is the property cycle in the end phase? The average asking price of a house in Britain has hit a new record, pushing over the £360,000 mark, according to property search giant Rightmove. This is an almost £20,000 rise in just 2 months, in a further blow to first-time buyers and people looking to invest in the property market. In what is still very much a seller's market, properties are achieving 98.9% of their final advertised asking price on average, and the time taken to sell has also halved over the past 3 years, from 67 days to 33 days.
While existing property investors may be enjoying the ride upwards, there are questions over how much longer this can last, given that house prices inevitably boil down to the average buyer's affordability, and we are in the middle of a cost of living crisis with interest rates on the rise. The last time that property prices crashed was during the years 2007 to 2009, We believe in the theory of the 18-year property cycle, which if taken at face value means there is another crash due in 2025, though in the real world the timeline is flexible and this could really happen anytime around now. Long term, this is not a problem, as prices will surely recover and boom again during the following cycle. But are we now seeing the final march upwards before the property bubble pops?
The Royal Mint NFT. The Royal Mint will create a range of non-fungible tokens, or NFTs, to be issued this summer, the UK Treasury has announced, in what is seen as its first of further moves into the crypto space. It has not yet said what these NFTs will actually be. An NFT is a one-off digital asset like an encrypted piece of artwork, and is an offshoot of crypto technology. They differ from crypto in that crypto coins are usually fungible, meaning they are interchangeable with other identical coins.
The UK government wants you to know that it's all over crypto. The announcement is significant because it's seen by many as a major developed economy dipping its toe into developing a full-blown centralised national digital currency to rival the likes of Bitcoin, though it may just be a PR exercise. You might wonder what the point of a regulated cryptocurrency might be, but that hasn't stopped China from making one, so why not the UK? Crypto fans, watch this space.
The yield curve goes flat. Over the past year, the US Treasury bond yield curve has been flattening. The flattening of the curve most commonly refers to the gap between the yield of a 2-year bond and a 10-year bond narrowing, which in good economic conditions should be far apart. Here, they are just 0.18% apart. This next chart shows the difference between the 10-year and 2-year bond yields over time. You want to receive higher interest on a bond that matures in 10 years' time than on one that matures in 2. However, as this chart shows, the difference in yield between 10-year and 2-year bonds has been approaching zero and are now about the same.
This matters because if we zoom out to the last 46 years of available data, every time that the variance has dropped below zero has preceded a recession, shown by the grey bars. As recently as 2019, there was a brief dip below the line, which was followed by a very brief recession. The worry now is that with high inflation, we may see a prolonged exposure below the line, which may precede a chunky recession like those seen previously.
Question of the day: what do you think the impact will be from Elon Musk buying Twitter? Join the conversation in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing in all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.